Right now, at this very moment, there are two completely different prices for silver in the world, and nobody is talking about why. In Shanghai, physical silver is trading at $99 per ounce. In New York, COMEX says silver is worth $74. That's a $25 difference. A 34% gap between what paper says and what physical metal actually costs. Let me ask you a simple question. If you walked into two grocery stores and one was charging $10 for milk, while the other charged $13.40 for the exact same milk, you'd want to know why. You'd assume something was broken. You'd assume someone was lying. That's exactly what's happening in silver right now. And by the time you finish this video, you're going to understand which price is real, which price is fake, and who benefits from keeping you confused. Welcome to Finance Currency. I'm about to show you something that the mainstream financial media refuses to explain. And once you see it, you cannot unsee it. Let's start with the basics because I want to make sure everyone understands what we're looking at. COMEX is the commodity exchange in New York. It's where silver futures contracts are traded. When CNBC puts a silver price on your screen, that number comes from COMEX. When your financial advisor tells you what silver is worth, he's quoting COMEX. When you look at a chart of silver prices going back decades, you're looking at COMEX prices. COMEX is the benchmark. It's the official price. It's what the entire Western financial system uses to value silver. And right now, COMEX says silver is $74 per ounce. Now let me show you Shanghai. The Shanghai Gold Exchange is where physical precious metals are traded in China. Unlike COMEX, which trades mostly paper contracts that rarely result in physical delivery, Shanghai deals in actual metal. When you buy silver on the Shanghai Exchange, you're buying real silver that gets delivered to real vaults. And right now, Shanghai says silver is $99 per ounce. Same metal, same purity, same ounce. Two completely different prices. I want you to sit with that for a moment. The largest paper market in the world says $74. The largest physical market in the world says $99. The gap is $25 per ounce. That's 34%. Now here's the question that should be screaming in your head. Which price is real? Let me tell you what basic economics says. In a functioning market, prices for identical commodities should be roughly the same everywhere after accounting for transportation costs. If silver is cheaper in New York than Shanghai, traders would buy in New York, ship it to Shanghai, and sell it for a profit. This process is called arbitrage, and it's supposed to keep prices aligned across markets, but that's not happening. The gap persists. The arbitrage isn't closing, and there are only two possible explanations. Either the physical silver isn't available in New York to ship to Shanghai, which would mean COMEX doesn't actually have the metal it claims to price, or someone is actively preventing the arbitrage from happening, which would mean the COMEX price is being artificially suppressed. Both explanations point to the same conclusion. The COMEX price is not the real price of silver, and I want to be very clear about what I'm saying here. I'm not speculating. I'm not theorizing. I'm showing you two prices in two markets for the same metal with a 34% gap. That gap exists. It's measurable. It's visible to anyone who looks. The only question is why. Let me show you the evidence. In October 2024, the London silver lease rate hit 34.9%. For those who don't trade metals, let me translate that. A lease rate is what institutions pay to borrow physical silver. The normal rate is 1 to 2%. A rate of 34.9% means institutions were so desperate for physical silver that they were willing to pay 35% annual interest just to borrow it temporarily. That's not a normal market. That's a market screaming for physical metal that doesn't exist. Around the same time, we saw the Shanghai premium expand dramatically. Physical silver in China started trading at 10%, then 15%, then 20% above the COMEX paper price. And here's what I found fascinating. As the premium grew, the financial media stayed completely silent. Not one major outlet explained why physical silver in Shanghai was separating from paper silver in New York. But I'll tell you why. Because explaining it would require admitting that the paper price is fake. Think about what a 34% premium means in practical terms. If you're an industrial buyer in China, a solar panel manufacturer, an electronics company, you're paying $90 for silver that COMEX says should cost $74. That's $25 per ounce extra on every single ounce for every product you make. These companies aren't stupid. They have armies of traders and analysts. If they could buy silver at $74 and avoid the premium, they would, but they can't. Because the silver at $74 doesn't exist in deliverable form. It only exists on paper. The paper says $74, the physical says $99. and industrial buyers are paying $99 because that's what it actually costs to get real metal in your hands. Now, I want to introduce you to a concept that ties this all together. It's called the paper to physical ratio. And understanding this ratio is the key to understanding everything that's happening in silver right now. On COMEX, there are currently about 400 million ounces of open interest in silver futures contracts. That means there are contracts representing 400 million ounces of silver that people are betting on. In the COMEX vault, there are 98 million ounces of registered silver available for delivery. Let me do that math for you. 400 million in paper claims, 98 million in physical metal. That's a ratio of roughly 4 to 1. 4 ounces of paper silver for every 1 ounce of real silver. Now, in a normal market, this wouldn't be a problem. Most futures traders don't want physical delivery. They're speculating on price movements. They close their contracts before delivery and take their profits or losses in cash. But we're not in a normal market anymore. Delivery demand is running at 98% in February. Industrial buyers are going directly to mines and paying 30% premiums to secure supply. Samsung just locked up 100% of output from a major silver mine for 2 years through a prepayment deal. The people who need real silver are no longer playing the paper game. They're going around COMEX entirely because they figured out what I'm about to show you. The $74 price is a lie. The $99 price is the truth. And the gap between them is the most important signal in the precious metals market right now. In the next section, I'm going to show you exactly how Shanghai physical prices are set, why they're diverging from COMEX, and what this tells us about where silver is really headed. But first, let me ask you something. When you look at your screen and see silver at $74, do you feel like you're getting accurate information, or do you feel like someone is hiding something from you? Because the evidence I'm about to show you suggests that the $74 price only exists to serve one purpose, to make you think silver is cheap while the real buyers pay $99 somewhere you can't see. Stay with me. Welcome back to Finance Currency. If you're new here, subscribe and drop a like. One click from you helps thousands more see this. Thank you. Now let me take you inside the Shanghai Gold Exchange because what's happening there tells you everything about the real silver market. The Shanghai Gold Exchange, or SGE, is the world's largest physical precious metals exchange. Unlike COMEX, where 95% of contracts are settled in cash and never result in delivery, the SGE is designed for physical settlement. When Chinese buyers purchase silver on the SGE, they expect metal and they get metal. This structural difference is crucial. COMEX is a paper market that occasionally delivers physical. Shanghai is a physical market that happens to use paper contracts for convenience. The priorities are reversed, and when priorities are reversed, prices diverge. Let me show you the current numbers. As of this week, silver on the Shanghai Futures Exchange is trading at approximately 8,100 yuan per kilogram. When you convert that to dollars per ounce, accounting for the current exchange rate, you get roughly $99. COMEX spot silver is at $74. The premium Shanghai buyers are paying for physical silver is 34%. And this premium has been expanding, not contracting, over the past several months. Now, here's what economic theory says should happen. If silver is 34% cheaper in New York than Shanghai, every trader in the world should be buying COMEX silver, requesting delivery, shipping it to China, and selling it at a massive profit. The arbitrage opportunity is enormous. We're talking about $25 per ounce profit on every ounce you can move. At those margins, you'd expect tens of millions of ounces to flow from west to east within weeks. The premium should collapse. Prices should equalize. But that's not happening. Why? Because you can't deliver what doesn't exist. Let me show you the COMEX vault data because this is where the lie becomes obvious. COMEX reports 2 categories of silver in their vaults: registered and eligible. Registered silver is metal that's been certified, assigned a warrant, and is available for delivery against futures contracts. This is the silver that can actually be delivered. Eligible silver is metal that's sitting in the vault, but hasn't been made available for delivery. The owner hasn't agreed to sell it. It's just being stored. Right now, COMEX has approximately 98 million ounces of registered silver. That's the deliverable supply. That's the metal that can actually be handed over when someone demands physical settlement. 98 million ounces sounds like a lot until you realize what's stacked against it. There are 400 million ounces of open interest in silver futures. There's industrial demand running at 700 million ounces per year globally. There's a structural deficit of over 200 million ounces annually, meaning the world consumes far more silver than it mines. 98 million ounces is roughly 50 days of industrial demand. That's it. That's the entire deliverable supply in the world's benchmark silver exchange. Less than 2 months of consumption. And here's what I find incredible. Despite this obviously tight supply situation, The COMEX price stays at $74, while Shanghai physical trades at $90. The paper price is lying. It's telling you there's plenty of silver at $74. The physical price is telling you the truth. Real silver costs $90, and that's if you can get it at all. Let me give you a real-world example that proves this beyond any doubt. Hecla Mining is the largest silver producer in North America. They just released their full year 2025 results, and buried in those numbers is a detail that confirms everything I'm telling you. The average COMEX silver price for Q4 2025 was $54.83. That's what the market said silver was worth. Hecla's average realized price in Q4 2025 was $69.28. Let me make sure you caught that. The market said $54.83. Hecla received $69.20. The largest silver miner in North America got $14.45 more per ounce than the official benchmark price. That's a 26% premium above COMEX. This is an SEC filing. This is audited. This is not a rumor. And there's only one way a mining company gets 26% above market price. Industrial buyers are calling them directly, bypassing COMEX, and offering premiums to secure physical supply. Samsung locked up 100% of output from the La Pria silver mine through a prepayment deal. They didn't go to COMEX. They went directly to the source because they know the COMEX price is fake and the physical silver may not be available. When the largest electronics company in the world and the largest silver miner in North America are both acting as if the COMEX price is irrelevant, what does that tell you? It tells you the $74 price is a fiction, a number on a screen that has less and less connection to reality with each passing month. Now, let me explain why Shanghai matters so much specifically. China is the world's largest consumer of industrial silver. Solar panels, electronics, EVs, they all require massive quantities of silver. And China dominates all of these manufacturing sectors. When Chinese industrial buyers need silver, they buy it on the Shanghai exchange. They buy physical metal that gets delivered to their factories, and they're paying $99 per ounce to get it. This demand is structural. It's not speculation. It's not investment. It's manufacturing input. Every solar panel needs silver. Every smartphone needs silver. Every electric vehicle needs silver. And as Chinese manufacturing grows, silver demand grows. As silver demand grows, the physical premium over paper grows. As the premium grows, the paper price becomes increasingly meaningless. We're watching the death of paper-silver pricing in real time. Here's another number that should shock you. In late October 2024, the London silver lease rate hit 34.9%. For context, the normal lease rate for silver is around 1 to 2%. A rate of 5% would be notable. A rate above 10% would be concerning. 34.9% is a 5-alarm fire. A lease rate that high means institutions were so desperate to borrow physical silver, even temporarily, that they were willing to pay 35% annualized interest for the privilege. Why would anyone pay 35% to borrow silver? Because they had delivery obligations they couldn't meet. Because they needed physical metal and the vaults didn't have enough. Because the paper positions they'd sold required real metal they didn't have. The lease rate spike is a confession. It's the market admitting, through price action, that physical silver is far more scarce than the paper price suggests. And it happened right as the Shanghai premium was exploding to 20%, then 25%, then 30%. Two markets, two continents, two completely different price signals. Shanghai says $90. COMEX says $74. Lease rates say physical is desperately scarce. Mining companies say industrial buyers are paying massive premiums directly. Every signal points the same direction. The COMEX price is fake. The real price is much higher. In the next section, I'm going to show you exactly how this manipulation works, who benefits from it, and why it's about to break. Because the mechanism that keeps silver suppressed at $74 is the same mechanism that's going to send it exploding higher when it finally fails. Now we get to the part that makes people uncomfortable. Because if COMEX silver at $74 is fake while physical silver trades at $99, someone is making that happen. Prices don't suppress themselves. So let me show you exactly how paper-silver manipulation works and who benefits from keeping the price artificially low. First, you need to understand something about COMEX that most people don't realize. The daily trading volume on COMEX silver futures often exceeds the entire annual mine production of silver. Let me say that again. In a single day, paper contracts representing more silver than all the mines in the world produce in a year can change hands. That's not a market discovering price based on supply and demand. That's a casino where paper bets overwhelm physical reality. And here's the key insight. When you can create unlimited paper contracts representing silver that doesn't exist, you can push the price anywhere you want. Let me give you a specific example from January 30th, 2025. On that single day, silver crashed 46%, from $121 to $64 in one session. It was the largest single-day decline in 46 years. Now ask yourself, did anything happen to physical silver supply on January 30th? Did mines collapse? Did inventories flood the market? Did demand suddenly disappear? No, nothing changed in the physical world. What changed was the paper world. Massive sell orders hit the futures market. The price crashed, and millions of call options that were in the money suddenly became worthless. Who benefits from that? Not the miners, not the industrial buyers, not the investors holding physical silver. The banks benefit, the large commercial shorts benefit, the institutions who had sold silver they didn't have and needed the price lower benefit. Let me show you the data on who's short silver. According to the Bank Participation Report, which is public information filed with the CFTC, 4 or fewer banks hold concentrated short positions in COMEX silver. These positions are massive, representing tens of thousands of contracts. One analysis estimates that JP Morgan alone is short approximately 5,900 tons of silver equivalent through various derivative positions. 5,900 tons is approximately 190 million ounces. The entire COMEX registered vault has 98 million ounces. These banks are short nearly twice the entire deliverable supply. And every dollar silver rises costs them hundreds of millions. Now you understand why the January 30th crash happened. Now you understand why the COMEX price stays suppressed while physical premiums explode. The banks need silver low. They need it low because they're short. And they can keep it low temporarily because they control the paper market. But here's what they can't control. They can't control how much physical silver exists. They can't control industrial demand. They can't force Shanghai buyers to accept the COMEX price. They can't make mining companies sell below what industrial buyers offer. The paper market is a game. The physical market is reality. And when games collide with reality, reality eventually wins. Let me show you why the game is breaking down right now. On January 30th, the banks crashed silver 46% in one day. This was supposed to kill the call options that were threatening their short positions. Millions of calls should have expired worthless. But it didn't work. Even after a 46% crash, approximately 35,000 call options on March COMEX silver futures are still in the money. These calls give holders the right to buy silver at prices below where it currently trades. The banks threw everything they had at silver, the biggest crash in 46 years, and they couldn't kill all the calls. Silver has since recovered from $64 to $78. That's a 22% recovery in 3 weeks. And with each dollar higher, more calls come back into the money. March 1st notice day is February 27th. That's when call holders can exercise and demand delivery of physical silver. 35,000 calls, if exercised, represent 175 million ounces of delivery demand. The vault has 98 million ounces registered. The math doesn't work, and the banks know it. Now let me connect this to why the lie persists. The $74 COMEX price serves several purposes for those who benefit from it. First, it makes silver appear cheap relative to gold. The gold to silver ratio at current prices is around 67 to 1. Historically, this ratio averaged 15 to 1 when both metals were used as money. The suppressed paper price makes silver look like a bad investment compared to gold. Second, it allows industrial users in the West to budget based on artificially low prices. If manufacturers believed silver was really 99s, they'd be stockpiling aggressively. The low paper price creates complacency. Third, it protects the short positions of the major banks. Every dollar lower is billions saved on their concentrated shorts. Fourth, it discourages investment demand. When silver crashed 46%, how many potential buyers got scared away? The volatility itself is a feature, not a bug. It makes silver look too risky for conservative portfolios. But the lie is getting harder to maintain. When Shanghai trades at $99 while COMEX says $74, the lie is visible. When Hecla reports realized prices 26% above market, the lie is documented. When APMEX can't ship for a month because demand overwhelms supply, the lie is experiential. The physical market doesn't care what COMEX says. Industrial buyers don't care what COMEX says. The miners don't care what COMEX says. And increasingly, investors are learning not to care what COMEX says. The real price of silver is what someone will actually pay to get physical metal in their hands. In Shanghai, that's $99. From mining companies, that's whatever premium industrial buyers are offering. In dealer showrooms, that's spot plus premiums that keep growing. The $74 price exists only on screens, in futures contracts that rarely deliver, in a paper market that has 4 times more claims than physical metal. I want to pose a question to you directly. If you could buy silver at $74, the COMEX price, and immediately sell it in Shanghai for $99, would you? Of course you would. Everyone would. The fact that this arbitrage isn't closing tells you something is preventing it. The silver isn't available at $74 for delivery. The price is fake. In the final section, I'm going to show you what happens next. Because the gap between $99 and $74 cannot persist forever, something has to break. Either physical silver comes down to meet paper, which would require supply that doesn't exist, or paper silver goes up to meet physical, which would mean massive losses for the shorts. I'll show you which outcome is more likely and what it means for everyone holding silver right now. We've established 3 things so far. Shanghai physical silver trades at $99. COMEX paper silver trades at $74. And the gap exists because paper supply is unlimited while physical supply is dangerously tight. Now let's talk about what happens next. Because this situation cannot continue indefinitely. Markets don't tolerate 34% price discrepancies forever. Something has to give. There are only 2 possible resolutions. Option 1, physical silver prices collapse to meet the paper price. This would require a massive influx of physical supply. Mines would need to dramatically increase production. Scrap recycling would need to surge. Industrial demand would need to crater. Let me show you why this isn't happening. Global silver mine production has been flat for years. There are no major new mines coming online. The largest silver producer in North America, Hecla, is increasing production guidance to 15 to 16 million ounces, but that's a drop in a 1 billion ounce annual market. Scrap supply is sensitive to price, but even at $99 Shanghai prices, we're not seeing the kind of scrap surge that would fill the gap. And industrial demand? It's growing, not shrinking. Solar panel installations are accelerating globally. Electric vehicle production is expanding. Data centers for AI are consuming more electronics than ever. Every one of these trends requires silver. The structural deficit, where consumption exceeds mine production plus recycling, has run for 6 consecutive years. The Silver Institute estimates the 2025 deficit at over 200 million ounces. Physical supply is not coming to rescue the paper price. Option 1 is off the table. Option 2, paper silver prices rise to meet physical reality. The COMEX price moves from $74 toward $99 and beyond. The shorts cover or get squeezed. The paper market finally reflects what industrial buyers have known for months. This is what's coming. And the only question is how fast. Let me show you the catalysts that could accelerate this convergence. First, the U.S. government just announced a critical minerals price floor system. Vice President J.D. Vance told representatives from 55 countries that the U.S. will establish reference prices for critical minerals at every stage of production. These reference prices will operate as a floor maintained through adjustable tariffs. The government of the United States just told the world that critical mineral prices, including silver, are too low and need a floor. Read that again. The government is confirming what Shanghai has been telling us. The paper price is wrong. Second, delivery demand on COMEX is running at 98% in February. When futures contract holders can choose between cash settlement and physical delivery, 98% are choosing physical. They want the metal, not the paper. This is unprecedented. Normal delivery rates are a small fraction of this. When virtually everyone wants physical delivery, the vault drains fast. Third, Chinese markets are reopening after Lunar New Year. When Chinese industrial buyers return, they'll be bidding for physical silver at Shanghai prices, not COMEX prices. Their demand adds pressure to an already stressed physical market. Fourth, those 35,000 in-the-money calls expire in March. If even a fraction exercise and stand for delivery, the 98 million ounce vault faces claims it cannot satisfy. Every catalyst points the same direction, higher. Now let me tell you what this means for you specifically. If you own physical silver, you own something that Shanghai values at $99 while COMEX values at $74. Your metal is worth more than your screen says. And as the paper market converges with reality, your screen price will rise to reflect true value. If you own paper silver, ETFs, futures contracts, you own a claim on a system with 4-to-1 paper to physical coverage. When delivery demand spikes, paper claims may not convert to metal. You own a ticket to a concert that's oversold. If you own mining shares like Hecla, you own companies that are already receiving the real price, not the paper price. Hecla's realized price of $69.28 against a cost of $18.11 gives them $51 margin per ounce. That's 74% profit margin. When the paper price catches up to the physical price, these margins explode further. If you own nothing, you're watching a historic repricing event from the sidelines. The gap between $99 and $74 is a window showing you what's coming. When it closes, and it will close, the $74 price is going to $99, not the other way around. Let me give you a framework for thinking about price targets. If silver simply converged to the Shanghai physical price, you'd see $99. That's 34% higher than today's COMEX price. If silver continued the trajectory that was interrupted by the January 30th crash, you'd see the $121 level retested and exceeded. That's 64% higher. If the structural deficit continues, vault drainage accelerates, and industrial demand keeps growing, you'd see prices that exceed any previous all-time high. Some analysts project $150, $200 or higher. And here's what I find most compelling. The US government is now building a floor under these prices. When Vance tells 55 countries that critical mineral prices need floors enforced by tariffs, he's telling you the downside is limited while the upside is unlimited. That's asymmetric. That's the kind of setup investors dream about. I want to address the skeptics for a moment. Some people watch videos like this and say, if this was real, everyone would know. The mainstream media would cover it. Let me ask you something. The mainstream media didn't cover the 34% Shanghai premium. They didn't cover Hekla's realized price being 26% above market. They didn't cover the 34.9% lease rate spike in London. They didn't cover the significance of 35,000 ITM calls approaching first notice day. If the mainstream media was covering this accurately, you wouldn't need channels like Finance Currency. You wouldn't need to dig into SEC filings and Shanghai exchange data and CFTC reports. The information is there for anyone willing to look. Most people aren't willing to look. They trust the price on their screen without asking who put it there and why. You're different. You're here. You're learning. And when the convergence happens, when $74 rises to $99 and beyond, you'll understand exactly why it happened while everyone else acts surprised. So here's my assessment for Finance Currency viewers. $74 COMEX price is not the real price of silver. It's a paper fiction maintained by concentrated short positions and unlimited contract creation. The $99 Shanghai price is closer to reality. It's what industrial buyers actually pay to get metal in their hands. The gap cannot persist. Either supply materializes to bring physical down, or paper rises to meet physical. Supply isn't coming. Paper must rise. The US price floor, the February delivery demand, the March options expiration, and the Chinese market reopening are all catalysts for convergence. When someone asks who's lying, the answer is the screen. The answer is the paper market. The answer is the system that tells you silver is $74, while the world pays $99. Drop a comment and tell me, do you trust the COMEX price or the Shanghai price? I want to hear your perspective. Share this video with one person who still thinks the price on their screen is real. Help them see what we see. And if you're not subscribed to Finance Currency, hit that button now. I do this research every day, digging into the data that mainstream sources ignore, so you can see the market as it really is, not as they want you to see it. The real price of silver is $99. Your screen says $74. The gap is your opportunity. This is Finance Currency. I'll see you in the next one.